My name is Jake, welcome to the channel, and today's video I want to talk about the best value ETFs for long-term investors. A couple of weeks ago, I made a video on the best growth ETFs for long-term investors, and there's a few comments where people were saying requesting to make a similar video with the best value ETFs. So I'm going to take a very similar approach in today's video that I did with the video a couple of weeks ago around growth ETFs. Now, before we talk about, what are the best value ETFs, I think it's important to understand what are the differences between growth and value. Okay, now, especially if you're new to investing, you've heard this before, growth and value, you probably picked up on it a little bit, but essentially growth is focused on future cash flows. Okay, and those cash flows are discounted into the future based off of what's going on in the economy and the market today. Now, on the contrary, with value or value ETFs, the focus is more on companies and businesses that have current cash flows. And when we think about these type of investment approaches, growth versus value, there's many different ways that you can approach it. But at its basic level, that's how you want to think about it. Growth, future cash flows, value, current cash flows, okay? And the type of companies that are in these ETFs will be dictated based off of that. So first off, I'm not going to be looking at any thematic ETFs that could be like semiconductors, oil, EV, for example, like utilities. Like utilities are great. There's a utility sector ETF, but I'm excluding sector specific and thematic ETFs. Second, I'm focusing on low expense ratios. The next thing is I want to focus on reputable issuers. And then the next thing is I want to focus on total return. So the capital appreciation plus the dividend, right? That's the total return. So I'm not just looking at high dividends or dividends. That can be confusing for a lot of people. So you can have a value ETF that is high dividend and not high dividend. The next thing is I'm only focusing on large and mid cap indices. Then the next thing is I'm only going to be focusing on market cap weighted indices. And then lastly, we're going to look at ETFs that have been around for at least 10 years so that we can back test the performance. Now, the ETFs that we're going to take a look at today, the first is going to be MGV. The second is SPYV. The third is going to be VOE, the fourth SCHV, and then the fifth VTV. And so what I'm going to do is I'm going to take a look at each one of these ETFs. I'm going to analyze the top holdings. I'm going to look at the expense ratio, all of that good stuff, similar to what I did in my previous video around the best growth ETFs. And then towards the end of the video, I'm going to stack rank them and I'm going to compare where they differ, where they're similar. So I think it's worth pointing out that the market works in cycles, right? What was working last year doesn't always work every single year. I'll give you an example. Last year, value did very, very well compared to growth when you just kind of stack rank them and compare them side by side. This year, year to date, value has been underperforming growth. Growth has been greatly outperforming, and you're seeing that in the net inflows, the inflows into these ETFs. So this year in 2023, we're seeing growth outperform value, where last year in 2022, value was outperforming growth. And generally in a market downturn and a recession, value is going to outpace or outperform. So in these bear markets, a lot of people are flocking to safety into these value ETFs. And it looks a little like this.
That fat is going to win him biggest boy at the state fair.
Peter, this is very serious.
So is biggest boy.
Well, he's a big boy. He's the biggest boy. He's a big boy. He's the biggest boy. He's a big boy.
Oh my gosh. Oh man. All right, cool. Okay, so let's take a look at the very first one. The first one is MGV. This is the Vanguard Mega Cap Value Index. So this is looking at the largest companies in America, large mega cap companies. So the first thing that I want to take a look at is the expense ratio. It has a very low expense ratio. They have a decent amount of assets under management, just around 6 billion. And as I mentioned at the end of the video, I'll stack rank all of them together. But what's important to understand is when you invest into an ETF, you're more or less getting what you're getting the performance of the index. So the index that the ETF tracks, whatever that is what's going to dictate the performance, right? And because these are passive indices, the performance is just based off of what the index does, okay? So it's not actively managed. That is the most important thing that you understand if you're going to be a long-term investor. If you're investing in these ETFs, you have to understand what you're investing in. So really quick, what is the CRSP market index, the US mega cap value index here that this ETF is tracking? Essentially what it's looking at is this ETF or this index is screening based off of the book, screening the companies in the index based off of the book to price, the forward earnings to price, the historical earnings to price, the dividend to price ratio, and the sales to price ratio. And obviously it's looking at the market cap of these companies, and it's weighting them based off of that. So this is the screening that takes place when you're looking at this particular index. And there's a few other ETFs that follow a similar approach to this. So I would highly encourage you, if you invest in one of these ETFs, or if you're considering it in the future, take a look and Google the index that it tracks and then read up and understand how the index works. Because if you understand that and you see the ETF go down in price, you have to understand and have conviction in what you're investing in. And if you do, you're going to have a smile on your face when it goes down, because you're getting in at a better valuation, a better price. All right, let's go back here and let's take a look at some of the top holdings. And let's see here. So with MGV, you can see here that healthcare is the highest sector. Now, this is very different than the growth ETFs. Remember the growth ETFs from a couple of weeks ago? Every single one of them had technology as the highest sector, okay? So healthcare, financials, industrials, consumer defensives are the highest, okay? The largest holdings, you got Berkshire, ExxonMobil, United Healthcare, Johnson & Johnson, JP Morgan, Procter & Gamble, and so forth, okay? So these are the top holdings, and once again, towards the end of the video, I'll kind of break down the top weighting, the percentage of the top 10 and the number of holdings. Next, let's take a look at SPYV. This is the Spider S&P 500 Value ETF, has a very low expense ratio. It has a good amount of assets under management. Now, the important thing, once again, is taking a look at the index. And the index that this follows is it's looking at the S&P 500 Value Index. So what it does is it takes a look at all the S&P 500 companies and it breaks them up based off of value versus growth, right? And then it market caps weight them, and it's not just looking at a specific sector, okay? And this is why I much prefer an ETF like this than a sector or an industry specific ETF. Now, I could definitely see myself owning like a utility ETF like VPU from Vanguard or something like that. But I like this. If you're just going to have one value ETF or just one or two, I much prefer this because you're getting much more exposure to the overall market, and it's focused on a value component of the market. Okay, so I much prefer this. Oh, if I'm only going to have one or the other, I much prefer this than a sector value ETF. Looking at the holdings, the largest is going to be financials. The difference here is technology is higher, healthcare is much lower. The top holdings, you have Microsoft. Microsoft is a value company in this sense. It's interesting. Microsoft can be a value and a growth. Quite interesting. Same with Amazon. Microsoft, Berkshire, Amazon, Meta, JP Morgan. If you were to look at this and you were to ask me, hey, does this look like a value ETF? I'd say, no, this is more of like a growth ETF, which is interesting, right? So the number of holdings, you're getting 400 out of 500 of the S&P 500, right? So this is definitely an interesting index to take a look at. The next one that we're going to look at is the only mid-cap ETF that we have here. The other ones are all large and large, and then the mega cap one. So VOE is the Vanguard Mid-Cap Value Index Fund ETF. It has a low expense ratio, good assets under management. And if you scroll down and you look at the fund profile, you can see that the index that it tracks is the CRSP US Midcap Value Index. So very similar to MGV, the one that we took a look look at the very beginning, okay? Looking at the holdings, you can see that financials, utilities, industrials are the highest. Technology is much lower, so pretty different. A lot of these companies I'm not going to be familiar with. There's a few that I'm familiar with. But one thing that I do like is that of the top holdings, the top 10 only makes up 12%. So I actually do like this. This is a little bit more, it almost feels like an equal weight, but it's not. It's just these mid caps. There's not such a difference between, a $2 trillion company and a $5 billion company. So you're going to have a much equal weighted index with the mid cap ETFs. The next one is from Schwab, the SCHV, Schwab US Large Cap Value ETF, a very good expense ratio. These all have good expense ratios. Good assets under management at $9 billion. And then when looking at the index, this ETF tracks the Dow Jones US Large Cap Value Total Stock Market Index. That is absolutely a mouthful. This is similar to SCHD and the others here from Schwab. They generally track the Dow Jones index or some variation of it. So that's something that I've noticed here very, very often, that Schwab really takes a look at the Dow Jones index. And so let's take a look at the holdings here. Financials at the largest, healthcare, industrials, technologies here down at just around 11. You got Berkshire, Exxon, Johnson & Johnson, JP Morgan, Procter & Gamble, Home Depot, Merck, Chevron. So very much like you can see Dow Jones, like this screams Dow Jones all over it. And you can see that the total holdings just under 20% in the top 10. And there's a large amount of holdings. There's over 500 companies in this ETF. So I tend to like this, but I think it'll be interesting to see the performance, how it stacks up to the others here. All right, now for the last one, VTV. This is the Vanguard Value Index ETF. It has a very low expense ratio. It has a very high amount of assets under management. Going on and taking a look at the index here, it tracks the CRSP US Large Cap Value Index. And then when we look at the holdings here, you can see that healthcare is the largest, financials, industrials, consumer defensive. I really like this. If you invest into like the total US stock market, you're getting so much technology, right? And so I actually really like the more exposure here into these defensive sectors. The top holdings, you got Berkshire, Exxon, United, Johnson & Johnson. So very, very similar with the others. And what's even interesting is you even got Meta, right? So you got Meta as a value, Meta combined with Exxon. It's such an interesting index. And you got just over 22% in the top 10 and 343 total holdings. Now, something that you're going to want to be very aware of is the fund overlap with these ETFs. This is similar to how it was with the growth ETFs in that video I made a couple of weeks ago. When you're investing in these ETFs that follow a similar index or a similar methodology, you're going to want to make sure that if you're going to invest in more than one of them, that you're comparing the fund overlap, right? Because you don't want to have unnecessary fund overlap. So just to kind of put this into context here, there's a couple of things that I want to look at. The first thing that I want to look at is how does it compare to the broader stock market? So the broader stock market is the total US stock market, and that is VTI. So what that means is you can buy one ETF, and by doing so, you can purchase every publicly traded company in America, and it is market cap weighted. I absolutely, that's how I invest into my Roth IRA. I set it and I forget it, right? I invest into America, right? And that's one way that you can do it. It's the most passive way to invest in America, as an example, and the American economy. And so if you compare SPYV, this is the S&P 500 value index, you can see that there's a good amount of fund overlap. Now, another example that I want to give you is, SCHD, for example. How does, both of these can be arguably value ETFs, right? SCHD, is a dividend ETF. So you would think, okay, well, it's a value ETF, right? It has a dividend. Well, let's compare and let's see how it compares to SPYV. When comparing it, there's very, very little overlap. So I could definitely see a world where you could invest into SCHD, and if you wanted to add a small, percentage or a satellite position, if you follow the core in the satellite, you could add SPYV, to your portfolio, and it would round out your portfolio in a very positive way, in my opinion, because you're getting more exposure to the market. Now, I want to be very clear. I've gotten some questions on this in the past. I am pro market, like pro exposure to the market. I know that there's a lot of people that want to pick stocks and, they can do that. Like, that's fine. You can do that. For the normal person out there, the average person out there, getting more market-like returns, in my opinion, is one of the best things that you could do. You're not going to always be able to pick the winners. And I've accepted that fact. And that's why I love trying to focus on ETFs and my investments that track more of the broader market. Okay. Because most fund managers that, they actively manage portfolios and funds, they generally underperform the market over an extended period of time. Okay, so that's why I'm such a huge advocate of passive investing, index investing. I'm a huge Bogle fan, Jack Bogle fan. So with that out of the way, I'm just trying to help you understand why I'm saying this, like, so you can kind of understand for yourself why that is versus just blindly listening to what I'm saying. But I'm trying to help you understand why that is. Okay, so let's compare another one here. If we compare VTV, for example, with SCHV, you can see that there's a little bit more fund overlap. Let's do MGV. This is the mega cap one, low overlap. Let's look at what was another one, VOE. There's going to probably be very little, 10%, right? Because this is the mid cap, right? And SHD is following the Dow Jones. Now let's take a look at the performance of these ETFs. Okay, so first off, what we're looking at here is I have this backdated to January 1st, 2010. And the reason for that is so that I can include all of them in this comparison. So that's why that date. In terms of what we're looking at here, you can see that we're looking at the price return. So this is not with the dividend reinvested. So we're just looking at the price. I'll show the total return here in just a second. But what we're looking at is you can see VTV is in orange. Blue, you have the S&P 500 just as a benchmark to compare. MGV is here in a purple, SCHV is in a light green, VOE is in a red, and SPYV is in a dark blue. Okay, now it's important to first point out, now the first thing that you'll notice is if you just go on Google Finance or Yahoo Finance and you type in these tickers, this is what you're going to see on Google Finance. Now this only tells half of the story, right? Because the total return, it's important to factor in the dividend. The dividend absolutely matters. So when we factor in the total return with the dividend reinvested, this tells a completely different story, right? So before, without the dividend, the S&P 500 was the highest performer. And now it's nearly the lowest performer. Okay, so everybody, dividends matter. They absolutely matter. So the highest performing over this time period with the dividend reinvested is actually going to be the SPYV. This is the S&P 500 value index. Now, SPYV, there's other ETFs out there that track the same index. For example, VOOV. But I actually like SPYV a little bit better because there's a lower expense ratio. Okay, so that's why I included SPYV instead of VOOV because of the lower expense ratio. So now let's stack rank these and compare these side by side. So let's take a look at the very first one here with MGV. I'm going to go left to right. Okay, so MGV, this is the Vanguard Mega Cap Value Index from Vanguard. The expense ratio is 0.07%. So that means if you were to invest for every $100,000, the expense would be $70. Okay, the inception was in 2007. Assets under management right at 6, so the lowest of the bunch here. The number of holdings, 146. The top 10 weightings, 27%. The overlap with VTI, once again, this is the total US stock market. The overlap was 35%. The 1-year performance, 1.5%. The 10-year performance, 8.5%. And since 2010, the total performance has been 298. So the yield on cost is if you would have invested 10 years ago, that initial investment what you would be yielding today, you'd be yielding a 5.1%. That is your yield on cost on your initial investment 10 years. And this is kind of showing the growth as well as, the dividend itself that you're getting and the cash flow that you would be getting for every dollar that you're investing. Yield on cost is very, very important. Next, let's take a look at SPYV, and this is actually from SPDR. This is actually from SPDR. It's the S&P 500 Value Index. It has a 0.04% expense ratio for every 100,000. You're paying $40. Inception of 2000, 15 billion in assets under management, 405 holdings, 25% in the top weighting, and then 55% in overlap with VTI. So a lot of overlap. Okay, now because this is focused on the S&P 500, and as we know, the S&P 500 largest companies in America, so that doesn't surprise me at all. The 1-year performance is 6.5%. The 10-year is 8.9%. And since 2010, it's performed 395% on a total return basis. The 10-year yield on cost is 4.1%. Now, this doesn't surprise me so much because, you look at the, year to date, mega caps and large caps have been performing much better than small and mid caps. So this is not really surprising. As we know, the market works in cycles. The next is VOE from Vanguard. This is the CRSP US Midcap Value ETF. Has a 0.07% expense ratio, which means $70 for every 100,000. Was created in 2006. 16 billion in assets under management, 193 holdings, 12% in the top weighting, and 8% overlap with VTI. Very, very low overlap with VTI. 1-year performance is minus 4.3%. Over the last 10 years, 8.7%. Since 2010, total return of 285% and a 4.4 10-year yield on cost. And it's kind of like I just mentioned. So the reverse of the large caps, the mid caps are not doing so well this year. Next, let's take a look at SCHV from Schwab. This is the Dow Jones U.S. Total Stock Market Large Cap Value ETF with a 0.04% expense ratio, which is $40. Inception of 2009, 9 billion in assets. The second lowest here, 518 holdings, 19% in the total weighting, 46% overlap with VTI. Just under 0.5% down for the last year, 8.5% 10-year total performance, and since 2010, 262 total performance, and a 10-year yield on cost of 4.1. And then the last one here, VTV from Vanguard, the U.S. Large Cap Value Index, 0.04% expense ratio, $40 for every 100,000. Inception in 2004, 97 billion in assets under management. That is the largest of the bunch here. 343 in total holdings, 23% in the top 10 weighting. The 43% overlap with VTI, just over 0.5% up for the last year, 8.1% for the last 10 years. Annualized, this is annualized, by the way. I forgot to mention that earlier. And since 2010, it has a total return of 298% and a yield on cost of 5.1. All right, so for me, when I'm taking a look and when I'm comparing ETFs, these are really generally the things that I look at when I'm trying to compare which ETF should I consider. Now, obviously, the expense ratio, the assets under management, the inception date, those are important. The very most important thing is going to be the fund methodology. And really, you have to pick and choose what methodology is best for you, what you would prefer. But objectively, when I'm looking at and when I'm comparing what are the best, and in my opinion, the largest number of holdings, the largest number of the holdings, the better. And I actually made a mistake here. It's actually this one, not this one. And so in terms of the largest number of holdings, I personally like SCHV. And once again, as I mentioned, I like having more market exposure. The more market exposure, in my opinion, as a Jack Bogle fan, I personally like that. Okay. And in terms of the top 10 weighting, I like to see more of an equal weight. It just, in my opinion, it takes away a little bit more of the risk to individual, company exposure. And so with that one, VOE is going to take it there. Now, this is the only mid-cap ETF. If you wanted to remove that, then you would take a look at maybe an SCHV or one of the others here, okay? So this is a little bit of, not so apples to apples, because this is a mid-cap where the others are large and mega, right? So that's something to point out. Next, overlap with VTI. In my opinion, the more overlap with VTI, the better. Now, this could vary depending on your portfolio construction, depending on how you have your portfolio set up. But as a blanket statement for the most amount of people, in my opinion, the more overlap with VTI, the better. Okay, the best 1-year performance is going to be SPYV, 10-year SPYV, and then since 2010, SPYV, and then the largest or the highest or best yield on cost here over the last 10 years is MGV and VTV. Now, the reason why these here is you're getting a higher starting yield with MGV because these are mega caps, right? Mega caps generally have a higher dividend yield. But all in all, in my opinion, I could see a case where you could invest into every single one. Like you could pick any one of these. And in my opinion, you really couldn't go wrong. It really just depends on how well this could fit into your existing portfolio. Me personally, I would not build a portfolio around these ETFs. I would, meaning that this is your core. In my opinion, I could see a case where you could have these ETFs in addition to maybe some of your other holdings in there. And in my opinion, the simple path to wealth with dividend investing, if you never want to sell your shares and you want to live off of the dividend income from your portfolio, my personal opinion that the simple path to wealth with dividend investing is to invest into SCHD and DGRO as your core holdings. And if you wanted to add satellite or additional positions at a smaller allocation, I could definitely see a case for adding, one or two of these ETFs to your portfolio if you wanted to get additional or broad exposure to the value, part of the market. I could definitely see a case where you could have one or two of these, as well as one or two of the growth ETFs that we talked about a couple of weeks ago. What it really comes down to is finding a balance and not going 100% in one or the other. It's a matter of constructing your portfolio in a balanced way that meets your goals. Thanks for watching, everybody. I hope that you learned something new. I'll see y'all in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.